thank you very much, everyone, for coming this evening for today's meetup. So I'm just going to do like a quick run, like an intro about Startup Grind, about what we do at Startup Grind, and I'm going to introduce our partners, and we're going to go straight into the panel for today. So just bear with me, I don't have a clicker, so I just have to do this very manually. Startup Grind is the world's largest community of startups, founders, innovators, and creators. We do this through our local events as well as our flagship conferences, collectively across 4 million individuals in about 160 countries, in about 600 cities. That's more accurate. Right? And we feature London entrepreneurs every month and through our non-profit activities. And this is our values. Our community is shaped by our values, the kind of members we accept, the kind of speakers we bring up on stage. We help others, we give first. We give first before collecting, education, we make friends, connection, and inspiration. So those are our values. I would like to talk about them a lot. And this is a team. I've got Prem, who's our chapter director. Got James, I'm sure you met James. I've got me and Gabriel, who's sadly not here today. And upcoming events. So we've got an upcoming event on the 24th of May, and we've got like a ticket. So we did this last time. Anyone who was here at our last event at Borough Market? If you're here at our last event at Borough Market. Okay, thank you. So at our last event, we also gave out free ticket for this event. So this is something we want to keep doing. So we're going to share a slide. So you shouldn't be in a hurry to go or leave. You want to attend the next one. Yeah. And you can find us on startupgrind.com/London. We've also got Facebook, social media, Facebook, Twitter, Instagram, and LinkedIn. We've also got like a newsletter. Our newsletter is very detailed. We share partner content. We share a lot of giveaways. A lot of giveaways that will benefit you as a founder. We also share like interesting information, interesting news happening around the startup ecosystem in London. I've also got amazing sponsors that made this event possible. We've got L1X, we're literally in the office right now. I've got Howard Kennedy and Mont Park. You're going to be hearing from our sponsors and our partners very soon. And yeah, we've also got Runway East and Supreme Factory. So Runway East partner with us with space, with venues for some of our events. They also give discounts to our members to use their co-working space as well. And yes, I'm going to call on stage, Chris, to come talk about LLS.
Keep it brief, everyone, so I don't really have to talk about payments all evening. But essentially, do you want to do the ticky thing?
Yeah.
I'm here. Let's keep going. Okay, so essentially, LLS, we're a global financial platform. So everything from money in, money out, and everything in between. So we work with companies of all shapes and sizes, from big ones to little ones. So whether you're a startup with your early idea and you need like sort of banking infrastructure, or would want to pay for marketing expenses on cards or take car payments online, we can help that. All the way up to when you scale up and go global. You're a bit quick there, no? That's all right. Okay, so so you can see that it's a pretty large platform. It's a pretty end-to-end, right? So in a nutshell, collect, hold, and spend multiple currencies. I think like lots of players can do it domestically, but when you want to move internationally, that's where Airways really comes into its fore. So opening local business accounts around the world, taking card payments online, doing some FX and treasury management in the middle, and then making bank transfers around the world and also paying with card payments. That's pretty much where we sit. We have representatives from the team here, myself obviously here, Hannah, over there, and Max, and then Roxy and Diana as well. But I think that pretty much sums us up, but thanks very much.
Apologies for having to listen to a lawyer speak. Nobody ever wants to do that. Don't worry, I won't charge you for this, so it should be okay. So Howard Kennedy has been attending Startup Grind events since 2015. In that time, we have met hundreds, if not thousands, of incredible individuals with some brilliant ideas. and with the drive also to turn those ideas into businesses. We've helped founders take the initial steps on this journey and advise businesses as they evolve into global brands. But for every success story, there are multiple failures. What we want to do at Howard Kennedy is take our experience from those failures and help you guys to make a success of your companies. We want to be more than a trusted advisor, we want to be an extension of your team. Through our Howard Kennedy Ignite programme, we've tried to remove some of the risks for founders with a range of benefits. From discounted fees to introductions to our network of investment funds, in particular VCTs, to helping founders find NEDs that can accelerate growth without giving away equity. Regardless of what stage your business is at, we'd love to have a chat, so come and find us at the end. Thank you very much.
Hi everyone, I'm Monty Montgomery from Monpac. We're an outsourced accounting firm, so we're like your in-house accounting department. And we work with a lot of startups, and we were founded by my father, actually. He was a 3-time Fortune 500 CFO. We currently have about 325 employees in the US, Philippines, and here in the UK, where we entered this market last year. We have over about 750 clients. Some are very small, some are very large, some are public, but mostly they're Series C, A, B, we scale with them. We've supported over $1 billion in venture revenue. It's probably a lot more than that because I've raised over 700 million myself, but in a very long career. It's not like I'm great at it. I've been around. And we have many successful exits with our clients. So the range of services, it's what you would expect internal people to do. Day-to-day accounting, closes of books, but we also do the strategic stuff, the FP&A, the capital structures, things that you need in a startup, and keep you in compliance as well, which is very important because that's a lot of problems stem from there, especially at the acquisition time. So why us? To summarize our sort of value proposition is we do proper accounting, but we're cost efficient and very scalable at the same time. So we have a team approach, and so there's not a single point of failure. And we're very proactive in terms of like trying to find opportunities for cost savings or bringing our network in. And a lot of what you want from a service provider is not just what they do, but the network that they know and bring to you. And I've had the pleasure to work with Jason Lincoln of Sasser for many years, so I put this quote on there because people know his name versus mine, obviously. And we have an offer. We'll give a discount for the first year's fees because we understand that a startup, burn is everything, and trying to reach those milestones without spending as much. We'll also review what you have now and give you some pointers there. We're really just trying to support entrepreneurship in general. And our local, Anthony Williams couldn't be here today, but I'm in town. You can reach us here or just go to monpac.co.uk.
All right, so without further ado, I'm going to introduce our panelists and our speakers to the stage. So we've got Monty, we've got Afshin and Andrew. Come up on stage and introduce themselves. Thank you.
Okay. So why don't we start with some introductions? Your background, your name, obviously, background, how you got into venture, what type of investments you're making, geographically, stage, industries, and just sort of give them a sense of what you're looking to do as a VC.
Sure. I'll start with myself. So I'm Andrew Sheffield, but my friends call me Chef. I work for a VC fund called Playfair, and I'm the principal on the team. I have done this now for like 3 years, and my job is basically finding founders and startups, leading them through our investment process, investing in them. I like to lead 2 new investments per year, and then post-investment typically help them with a couple of things. So one is I run and structure every fundraise across the portfolio, and I like to help with sales and go-to-market stuff as well. So that's what I did before. I worked in a startup. I was the first commercial hire at a fintech, just as the founder was handing over from founder-led sales to building something a little bit like a sales team. Joined as employee number 6 or 7 and left as employee number 40 there. Before that, I played poker professionally in a few different cities around the world as my only source of income, until all the casinos got closed when COVID hit. And if you can imagine like how like COVID insecure a casino is, right? Everyone's like touching the same chips and cards and stuff. So when I closed, I had to get a proper job. So I joined the tech world. So that's my personal intro. Do you want the fund one, or shall I?
What domain?
Sorry?
What domain?
Domain.
Like you'll find
Okay, yeah, sure.
what about a toothbrush dish?
Sure, yeah. So Playfair, we're a £50 million fund. We invest in mostly B2B businesses and mostly mostly technology businesses. So we do invest in hardware as well. We are sector agnostic but stage specific. So what that means to us is that we can invest in most industries, but we like to be the first venture investor into early stage companies. And getting our companies to Series A is, bless you. Getting our companies to Series A is, and that bit of the journey is the bit we really focus on. Around 70% of the companies that we back make it to a successful Series A term sheet, and we put that down to making high conviction, low volume investments. We only do 6 per year in a range of different industries.
Are you interested in scale-ups? I mean, what do you do about the...
So if it's a scale up, if it's the kind of like, if it's past the pre-seed, it's too late for us. And we sometimes see companies that we have, we think are really interesting, either seed or Series A, and we say, damn, we missed it. We should have been there earlier.
So we're gonna have some time for Q&A at the end.
Hi, my name is Ashton Wyatt. I'm a partner at Razor Capital. We invest primarily in emerging markets, so a different reality. As a whole, we started in Bangladesh, we're the first fund there, then started an activity in the Middle East, and now we're expanding across Asia, so it's Bangladesh and Southeast Asia. There are certain geographies we don't invest in, others we focus in, but we can't go into detail further. Our sweet spot is Series A because that's where we can add value. Based on the team size and our backgrounds, we're all operators and entrepreneurs prior to that, and investors on the side. We thought we should do our investments ourselves, and then based on that, we started to do it as a shop. That's the journey of the last 8 years, I would say. I've been living here for the last 12 years, although originally from Luxembourg. I had a startup that I started over there and grew well. Bootstrapped it, went through the journey, and sold it after a while when I realized that, well, you end up being right from a product perspective isn't always commercially viable, but you also don't plan timing. So sometimes you need to be able to let go and see, well, whatever you build has more value with a larger organization. That's what the journey I went through. And I didn't plan to be a VC. I just was friends with other VCs and figuring out what am I going to do next. And they were like, well, if you have time to waste, come and join us. And it's been 6 years of time wasting. But yeah, that's in a nutshell.
Right. So last few years were kind of crazy. 21, 22, high valuation, a lot of funding. Then interest rates changed and the market got tougher. What is your sort of take on the current VC market now in terms of valuation, fundability of companies?
On their Series A stage, things have changed quite a bit. We were financing mostly companies in emerging markets who at the time, during COVID, actually ballooned and left reality pretty quickly because we realized that valuations were given by firms that were tourist investors, as we call them, that were looking to do deals in new markets and did not care about due diligence the same way we did or market sizing. So a company that would probably do $1 million revenue suddenly was getting term sheets at 30 to 50 times multiples, which was not something we had seen. We usually invested between 3 to 5 times. So we were like, okay, this is definitely not a time for us to play aggressively. Now, those people are gone. Some companies got some funding and now they raised money at valuations that don't add up. So we are dealing with a lot of discounted terms based on the last rounds, but that are more or less priced fairly. So it's about a lot of cleaning up of cap tables, finding exit opportunities for existing investors, or being able to spin a nice story for what on the cap table might actually look disastrous. Or sometimes you see companies who start on a clean sheet. So it's been good in some ways to have that retreat, because those who really had the business, they're still getting funding. The terms might have bit slightly less founder friendly, but they will still be able to raise. And that's for EM, still tough. Like before, an average round would take 9 months. Now we're looking more at something around 14 months
To raise a round?
to raise a full proper Series A. Yeah. So the delay, it's taking longer. The sources of capital are there. What we've seen though, in terms of if you're still building a SaaS product, you definitely will beat most of the other guys at fundraising, just because it's easier to assess and you might do it. So that's the I would say, yeah, the oddball in the mix. But that's my view.
.ai in your name. That
Well, yeah.
helps a lot.
I mean, I joined the industry 3 years ago in like the peak of the manic era, and things moved really quickly at the early stages. So it was very normal for founders, at least at the pre-seed stage, to go out to fundraise and have a term sheet within a week or two. This was quite normal. Last year, it was far less normal, and now I would say there's almost 2 buckets of companies that I see that I see in the market. So probably 5% of companies that have a AI engineer out in DeepMind, they'll go into the bucket and they'll raise within a week, and they'll raise at very, very favorable terms. For 95% of the market, it takes a little bit longer. Founders typically have to have a little bit more traction. You have to have a little bit more proof points. But we're seeing loads of companies, and at least at the earlier stages, I'm really excited about the prospects of the market.
That's great. So what companies, how would you, for what you like to see, how would you want these companies to be positioned in terms of the milestones they reach, in terms of, MVP, post, initial revenue, growing revenue?
Yeah.
What is most attractive, and how could they position their company
Sure.
most likelihood to get capital?
Sure. So for us at the pre-seed, we do invest pre-revenue. About half of the companies that we invest in are pre-revenue, but typically for pre-revenue companies, we want to see some proof that what you're building is something that people want. And that's basically, have you hacked together a janky version of the product and you've shown it to 50 of your buyers, and 20 of them have said, oh, if you can build these features, we'll buy it and we'll write it down, and we'll be willing to tell venture investors that. So that's kind of normal for us. Obviously, we would prefer to have some revenues, and ideally you'd have to prefer to have increasing revenues. But yeah, I always say to founders, before you go out and fundraise, you should write down maybe your 5 core assumptions to your business. Like, what's really, really important to your business, what do you believe, and then how have you validated each of them? So this is your belief. Okay, how do I validate all these points in the market with some proof that I could show investors?
So, well, given we're a bit later in the food chain, the revenue part needs to be substantial. So we would expect you to have customers that not only spend money regularly, but don't leave. So the churn rate will be important, but most importantly, what we look at in terms of the quality of the revenue is the risk associated with the revenue you actually earned. So was it a one-off? Were you lucky? Was it a timely window where everybody wanted a specific feature that you had to offer? So it's a lot of market comparison that we need to do, saying, okay, who are the real threats? Do you have a forward story in a sense where, okay, you are on a trajectory to understand what the market needs and we should just help you make more of that? Or is it more strategic, okay, you figure out one type of customer, one type of profile. There are so many more that we need to add. How do we get to that? That's part of the challenges. Beyond that, I think we're looking at founders who are mission driven, because in emerging markets, if you just are looking to make money, you're not going to last. You might have stomach to do it for 3 to 5 years, but the cycles and the volatility there are quite different in terms of market stability. So you might have a terrible year, but then you have bounced back the next year. So it's that element of resilience that needs to be very high. We also have an internal policy that no assholes. So if you're someone who is unpleasant but is very successful, and we won't be able to deal with the next 10 years of the journey together, and we'll see that we'll have a challenge in having difficult conversations together from the get-go, we will retreat, because it's a waste of their time and ours, because it's just a disaster waiting to happen at either this next fundraise, or you're having a great time right now, but when push comes to shove, you'll probably be not so pleasant to deal with, or you'll be ready to do things that are not ethical. I mean, we've seen some of those actions as well in the past where we were uncomfortable with the level of risk that was taken. So this is also something we need to be careful in EM. Also, a nice story is a nice story, the impact as well, until you have to go and do your own due diligence, which we always do. And yeah, some founders are very good at creating fake companies. And we wish sometimes they would put that energy and make it real. I'm sure they will be able to pull it off, but we've seen companies that had like crazy growth rates, and then the customers seemed real, but then you actually went 2 layers below, and well, they were channeling funds from one company that was a service provider, but were able to raise money from a very, let's say, famous VC at the specific round. They don't want to touch it anymore, but they have enough money. You get into problematic situations, so we try to avoid that.
I like the no asshole rule. I think that's excellent, because those people, they can't build a team around them, right? They won't scale the business because there'll be constant revolving door around the executive suite. What are some of the other things that are just like killers, or just makes you recoil in fear of making the investment?
So for me, there's very few like pure red flags, I would say. There's like a deep amber or deep orange flag usually, but like in the fundraise process, founders have to run a really tight line of selling the vision and the story whilst also being true to the truth. And it's easy to sway into something that isn't quite true. And if we found there's a customer that you say you have and you don't, it's just that's the line of a red line. Some other things, look, we're technology investors. We typically like companies that are building their own technology. We have some for less tech-enabled models like marketplaces, maybe business innovations, we have some exceptions, but for businesses that are leveraging tech, we typically want to see it built in-house, or at least planned to be built in-house. And then maybe one of the dark amber flag would be like funky cap tables. We see it a lot. So like some university spin-outs, some advisors having 30 or 40% of a company. To us, it doesn't set a company up for success because the founder needs to be incentivized over the course of the rounds, and that is basically a red flag for us as well.
Let's start from the cap table perspective. What we see a lot in emerging markets is people who own shares in other people's names. And that's a very tricky one, because you need to go quite deep in the conversation to kind of filter that out. It's not something that will come in passing. You will need to ask, well, can I see your cap table? And then you suddenly see other names that were unrelated to the business, that were not part of the team, not part of the investor list, and they own 15%. And we're like, who are they? Oh, he helped me in the beginning, and he lent me some money, and I don't have to pay back. So was it an investment? Well, no, we have a gentleman's agreement. Okay, but he's actually effectively owning shares. So we have had a few of those. So that's depends on the individuals that are involved. That's a very strong amber. It's either you solve it and you come back to us and you clean the cap table issue, and then we'll get a copy with our lawyers to check if everything is in place. We will also check from a cap table perspective. I think what's a no-go is when you lend money to the company and you want that loan to be paid back instead of putting it into equity. So if we're willing to take the risk, but you're lending money, we would actually give you a way to get more shares in the company you're building and you're invested. But some people have tried to raise funds to pay them back. So for a loan, I'm not gonna take 2 steps in and then 1 back. That's something we're not comfortable with. We want to be aligned with the founders. Another thing we've seen is specific clauses, but that comes later on in the conversation, is when they're allowed to sell shares. And that's something that's often not talked about, but that comes usually in the shareholder agreement conversation. People will try to have freedom on when they want to sell shares. Listed companies have windows for employees when they sell. We want to have the same standard when we deal with founders. If you want to get liquidity, we're all for that, but the same rules should apply to all the shareholders. So if you have another shareholder who also wants to liquidate their stake, whatever the amount, so it be you want to liquidate 2%, everybody should have the same rights. Sometimes this has been a sticking point where a founder thought, well, that's my company. I was like, yes, but the rights that are allocated to the shares are the same for everybody. So that was a sticking point where we had to waive a term sheet in the past because we're like, okay, we were not able to come to terms. Well, that's from one of my partners, but he's a bit OCD. It's an Excel sheet that is not clean. So that will lead to further financial conversation that usually founders don't want to have. And just that will be a trigger for a deeper dive because we want to say, okay, are you able to actually put a formula in or not? And sometimes when you actually drill a bit, you see, well, they don't always add up. So that's a big amber. And then if they don't come back and can fix it, then it's a no. Because you cannot control your own numbers. How can we then be trusting your numbers whenever they come out? Except if you want to outsource this whole CFO, that's a solution. But yeah, not everybody thinks of that.
So the cap tables come up quite a bit. Are you guys familiar with cap tables, right, and the importance of it? And I think it's just a reminder that they can't be too weird because that causes concern and it's going to slow things down. And good legal counsel will help a lot to keep it in terms of the normal parameters of what is a good set of terms. And then, just they're fixable. So don't be discouraged. They give time. If we can fix it, great. So there's a lot of things I like about companies, right? And some of the new you look over or you help them repair things. So what is an example of a company that came to you and the fundraising just went very smoothly? What were some of the things that stood out, that they were prepared, that, upfront, transparent, and the process went so smoothly and hopefully turned into a great investment for you as well?
Yeah, there's a few that spring to mind for me. We have a business called AeroCloud. They're actually based in the north of England, which is home for me. But based in the north, and they are airport management software. So they are cloud-native software for operators to manage airports. That's everything from mapping people as they come in. Airports are incentivized to get people in shops, and currently they have massive, huge incumbent, old systems, multi-billion-dollar companies that are janky, not cloud-native, and don't work. We had a founder who actually didn't go to university. He was a racing car driver in the F3. Quite a successful one, and he came to us and he said, look, I'm going to change this market. There's two massive incumbents, they're both crap. I've done all this research. I've got two airports signed up, and I've not even got a product yet. There's a really clear need here. For us, this is really exciting. It's like he could sell ahead of his product. He has proven that there's a huge need. There's very little competition. The competition is slow, doesn't move very quickly, and the market is massive. So yeah, maybe the bit I didn't add earlier around what we're looking for. I think we see a lot of businesses that aren't really, really shooting big, and we want to see people shooting really big. So multi-billion-dollar markets, any market that doesn't have a B on it in terms of market size, we will probably just ignore.
Yeah.
I mean, the B is important, right? If you want venture return, at least the market should be big enough that even if you have a minuscule amount of that market that you'll be able to get with, let's say, venture money, it will justify the whole venture. Otherwise, you're spending a decade or more of your life for something where the math doesn't add up from the beginning. And we've sadly seen that, even with companies that went to prestigious programs, Y Combinator and others, especially in the markets we cover, where they say, well, actually, after 4 years in, we realized our market is not bigger than a few hundred million, because obviously only 10% of the population actually falls into that bracket.
Right.
Okay, we have and our margin is only 8%.
Do you independently check the market side?
We would challenge them, because at some point I was always served the same. Well, given we focus on a specific part of the world, so our research has been deep, and we have people locally who help us out, so that's important. But I get always pitched on potential. Nobody really gives me the reality. So if you're able to give me what are the numbers today, where were they before, and take the trend backwards, not just forward. Because forward, we can all say, oh, it's going to be fantastic. But if you can justify that 3 years from now we were nothing and now suddenly it's a real market and we're a player within that market and we're relevant, that makes my whole journey much easier in terms of market assessment, which is especially important at Series A. Now, in terms of preparation, I've had founders who had a very clean data room. So if you already put all the data in place without me having to chase for a month or two part of due diligence and asking, hey, can I really bother you for like a copy of the contract you have with your biggest supplier? Oh yes, I have to ask. We need to formalize that. I'm like, okay, well we have bottlenecks here. So we had to have experience where a company had been through Y Combinator, so they had some expectations on knowing how to manage investors, but nobody's trained in dealing with investors if you haven't been in the finance industry. So it's about how you engage with people. I think most founders we've dealt with were they had a high level of integrity. When they didn't know, they said they did not know. And that they will find a solution to whatever question we had. So I think that's usually what we value the most because it makes our life easier and theirs. And it's usually not a red flag if you're being honest. So you won't shoot yourself in the foot. So I think that's been great. And one of the funniest, most bizarre processes was a founder once asked me, why are you doing this? Why are you investing in my company? I'm like, well, you want me to change my mind? Well, no, because you're the first investor who's put so much time and effort to understand and interview people in the company. So he had raised a lot of money just by calling up people and having Zoom meetings. I was probably the second one who actually physically went to his office. So yeah, that's a funny one. Yeah.
Yeah, we do market sizes, but I think it's really important for founders actually to figure out what your actual market is. We get a lot of businesses that will say, we're a cybersecurity company. The cybersecurity market is £1 billion.
Yes.
Okay, great. That's cool, but what's the bit that you're selling? Oh, you're selling to threat intelligence people. Okay, what size companies? Okay, and we'll do that for every business. So we'll do bottom up market size, or we'll find the actual buyer, we'll go and interview them, figure out how much they would pay, and then multiply it by the number of buyers in the world or in your market. If a founder does that and brings that to us and it's accurate, that's really impressive, and we rate it quite highly.
It shows the forethought, and it leads to the strategy that they're good at. And your go-to-market is your background, so that makes sense. Mm-hmm. How's our time? Do we have time for a few more questions? So are there any companies you passed on and you're like, oh, God, I wish I could get that one back and make that investment?
As a personal investment or with the firm?
I think either, yeah. I think they both kind of apply. But the firm is, some firms have, this is our portfolio, these are our exits, and these are the ones we wish we had done, and they're open about that. They just chose wrong. And it's your career is obviously 20 years, but have you found some where you're like, okay, in second thought, I should have been okay with this term or this attribute of the startup?
We as a fund, we passed on a company called Mana Aero, which is an island-based company which does drone-based medical delivery. We passed on, they were valued at a few million, and they're now definitely a few billion, if not more, and still growing very quickly. We passed on 11 Labs, which is one of the really fast-scaling tech companies in London. That one really hurts because they scaled so quickly. We passed on Hopin, which was okay in the end, but felt really bad for a while as well. So yeah, we miss more than we get, actually. We have to be okay with that.
That's the industry. Yeah. Any notable ones?
A few. Well, the thing is that it all depends how much capital you have. So we also run a very tight portfolio, and we like to go pretty deep in terms of the company we get in. We haven't lost any of our deals yet. We had a few exits, but the hard part is to say, okay, how many can we actually manage? Should I go there and write multiple smaller checks and be in more companies? My value is limited. It's capped at some point. So we passed on companies that had nice trajectories that we didn't feel comfortable doing, which, well, I'm happy I haven't done it, but the market doesn't think the same because they have the media is propping up certain companies sometimes. So the first conversation I have with, let's say, LPs, and that's where it comes up usually, is why didn't you do that deal? That's in your market after all. Well, it didn't feel right, and I believe the company probably has raised $200 million, but still has no product market fit. But the LP will challenge, well, but do you really care? I'm like, well, I know 4 other funds came in afterwards, but if you don't control your way in, so that's an odd one. Then there is one that we probably, I'll fix the mistake, I would say, that I've done initially. He approached us for an angel check. We don't do angel checks. He wanted to do cow financing. Okay, it sounds a bit absurd.
Cow.
Same reaction. And the best part is that I'm like, I had a hard time understanding what he was trying to do, because I'm like, okay, you want to help a farmer buy a cow. I understand the value of protein being higher than wheat or rice or whatever you're growing, but why would you come in? There are cooperative banks, other ways. And he wasn't able to articulate what he was trying to do effectively. And the other red flag is him and his buddy had each a startup under the same entity. Like, okay, can I have 2 companies? Like, too many red flags. It was asking too much of my time. They wanted $50,000. I felt like, okay, that's going to go out of my pocket, or some of our fees we're going to make. How are we going to manage this? I saw more reason not to do the deal than spend more time. So actually, I realized it was my own bias who kept me from doing that. Now, that company at the time was raising 150K at 1.5 million. That company, that was December 18. Now, they raised around $3 million historically. They just closed their revenue last year at $54 million.
They really milked it.
Yes. So the funny part is, well, they didn't end up doing what they said they were going to do, because the market actually told them to, well, they were not interested in cows. They started doing supply finance for farmers. So it became seeds, it became fertilizer, and then they built a whole ecosystem around it. Cattle came in later, but I learned a lesson.
Yeah, there's a lot of good pivots like that.
And then on the personal side, I said I passed on Yonder as an angel investor. A couple of my friends invested, and I was used to, because I work in EM, at much larger sample sizes in terms of numbers. So when I see a product market fit, I expect, okay, your goal will be like to have 10,000 users, 50,000 users or more. Not high expectation. But I remember in the pitch was, yeah, we're going to want to validate with 1,500 customers. I'm like, that's so low. Like I had a hard time figuring out that the data of that sample would be effective enough to kind of back them. I should probably just follow my friends and shut up. But yeah, that was my mistake.
Yeah, interesting. So should we open it up for questions now?
YC has a rule that they won't back a company that only has 1 founder. Do you have that rule when you're considering investments?
No. So most of our founders are 2 or 3. We think we generally like 2, like typically a commercial and a technical, right? That's the kind of team we like to see. But out of 35 companies in the portfolio in the past 5 years or so, probably 5 or 6 are solo founders. Actually, a couple of our best ones are solo founders as well. So yeah, it's not a rule for us.
We haven't backed solo founder yet, for the simple reason that none of the teams we've seen had the ability to do it all. I've single founders have pitched me, but for the markets we're covering, if you're alone at it, you either need to be super connected or have extreme access to cash to be able to buy yourself through problems. It's not a no, but it will probably require deeper DD on the founder in terms of testing him much longer than we would usually do. Like spend a lot of time one-on-one or with their teams to see if there is a change in behavior. The thing is that the aspect of accountability that you see in the founding team often makes your job as a VC easier. Because they will challenge each other, they will do the mental sparring, they'll be able to have that conversation. When you're alone, Well, you're only accountable to yourself, so it depends how much of a healthy discipline you have. But yeah, that's been a bit more difficult for us.
How much is Gen AI making a mess of your landscape these days in terms of the profile of companies that are coming to talk to you, the sort of things that, the kind of what you need to get on top of to understand the technology?
So well, funny enough, the usage of Gen AI in emerging markets is pretty high, but not where we expect it to be. So it's mostly customers or consumers using it to just deal with queries or things they need help with. It hasn't affected business operations yet. We expect that to come a bit later. Some companies are using it for their own operations in which we've invested. We're like, okay, great, we figure out a use case. Most companies that we've seen, well, they call it AI, but based on our limited understanding, it barely fitted the qualifications needed. And on those questions, when we don't know or where we're unable to assess ourselves, we'll bring in, let's say, people in our network to give us a second view, second opinion on it.
A question. You want to answer as well?
Yes, yeah. Basically, have you ever had experience of investing in companies which operate in the normal legal structure, but then also own cryptocurrency with investor mechanisms and like buyback systems? Have you ever have you had any experience in that?
Not effectively, not that far. Where we had conversations, but it stayed at that.
Okay.
Yeah. I mean, the same question as you asked about AI. What about Web3? I mean, everything's going Web3 now. It needs to because of the environmental issues and whatever running big data centers. Are you getting that as a core of what's being offered?
So we are getting a lot of Gen AI, lots, and it's a huge technology shift. That means that new and, in my opinion, it's a huge technology shift. It means that new startup businesses have a chance against incumbents that are going to be slower to adopt. So we are seeing founders from every single vertical tackling different problems with this new technology. As a pre-seed investor, that's really exciting. We're seeing less on Web3, honestly. So there was a time when...
If somebody builds a 1.2 billion data center out in Milton Keynes a month ago,
yeah,
that 1.2 billion should have been invested in Web3 because it's distributable and it's clean. I'm surprised you're not seeing it.
Yeah, honestly, we're seeing less. I think a lot of the founders that would have been building in Web3 are now building in AI.
The government's going Web3, why not you?
Yeah. That's a valid point, yeah.
How important is it for you for founders to already think about their exit, like not their specifically their own exit, but in general the exit of their company?
We don't like it. I don't want to see an exit slide on a deck. I don't want to hear a founder say, we're going to IPO in 5 years, we're going to exit to this company in 8 years. Ultimately, you don't know, we don't know. It's so far away that it's a bit silly, in our opinion, to say how and when you will exit. What we like to see is the scale of the ambition of the problem that you're going to solve. So say you are in a business that does sustainable cement. We did the pre-seed, she just raised £20 million Series A to build a factory that manufactures sustainable cement. She's not looking and saying, oh, we're going to get to X amount of revenue and then we're going to exit to this company. She's saying, we're going to take over the global cement industry and we're going to be the leader in global cement. And that's the kind of narrative that strikes well with investors.
So to answer that question, I come a few years after he has invested. So by then we want to have certain indications of so having figured out something. And I think for us, the difference would be that, okay, you've gotten a reality check on what you can do. Now, based on that input of information, where do you think you are? So it's mostly about, okay, 3 years ago, your goal was this. What did you actually execute on? How far did you get? And what was your old target and what's your new one? And we're never going to push a narrative on the founder. It's always their choice on the targets they want to put on themselves. They should be accountable to their own targets. Let's say, I want to grow. I'm like, sure. How much? Where? And they will give you a reason for that and we'll simply challenge it, see if it makes sense and say, okay, sure, let's go. Let's do it. I mean, we're there to enable them. Now, if they realize 5 times that they were wrong, we need to have a conversation because we can wait 15 years potentially, but that would be, as a manager of a fund, the extreme limit of when I need to return the money to my investors without looking bad. Now this is an extreme case. Sometimes you struggle a bit. You need 5-7 years before it really takes off, depending what type of business you're building, especially if you're building SaaS or other. We've seen that it's not always the first few years that's going to validate that. So it depends on the vertical. Yeah.
I would actually just add that knowing the exit landscape is important, right? Knowing where exits could come from. But at our stage, we wouldn't want to see the really detailed plan to exit.
I mean, if we see the stage, usually what you want is someone who just wants to build for the next 2 years.
Yeah, build great companies.
That's the plan.
Exits follow.
That's the plan.
And don't do things that stop exits. Which is, there's a lot of them, but I won't bring them up. Any other questions? Yes.
Deal size?
Deal size. So for us, rounds of say small as £300,000 and as large as 4 million, and we write checks of up to about £1.5 million.
For us, on average, it's between 1 and 2, but most 1.5 is usually the ticket size we write. For EM, this is within the reasonable range. Some people do bigger checks. We feel that's already a lot of money for those markets. Now we do smaller ones at seed, but that's usually if we want to have access to a founder early to then lead terms. I mean, I'm going to be transparent. This is the reason why we do it. We believe in the founder. We don't think he really figured everything out, but he has a potential. We were at $100,000, and we don't have a specific expectation. We want to learn with it, and if we can make up for that $100,000, if we lead the term sheet afterwards.
Do you generally lead?
Yeah, or co-lead, or
and take seats, board seats?
We do most of the times because it's a market that we know best. There aren't 55 people they can go to, so at some point the other shareholders will also want someone who has the knowledge. Now we try to commit to doing it for 3 years, not too long, depending on the company, because our energy and input also has a limit, right? If you're at Series D or C, I'm not that useful anymore. We need someone else. Except if we have a very sizable stake, then we will try to stay longer.
You had a question back.
Going back to something you just said previously, so I know connecting the dots backwards is like a trillion times easier than connecting it forward. It's the official algorithm that I put together. But on your point of seeing where they want to go with it, that's something else that I've kind of been told, and I want to know where your perspective sits on it. Is doing that one thing now really, really well. I.e., like if you look at Facebook when it started at hot on hot for universities, or like Amazon just books, right? But then they may not even know how much it can grow. Maybe they have some idea, but maybe Jeff Bezos did. But the idea of, do you know in the beginning how much that one thing can scale? How much emphasis do you put on how good are they at knowing, can they do this one thing exceptionally well now, versus can this one thing then become whatever in the future, we should start.
This is a narrative we see very often, which is we are building product one, which solves this problem in this market. This market isn't necessarily the big one, but we've found our wedge in to something a lot bigger. After that, we just want to see the thinking, what's the scale of your ambition as a founder, right? You're going to solve product one, you're going to get to 50% market penetration, whatever it might be. You're then going to solve product two because it leads naturally in, and then you're going to solve product three, and suddenly we've got a really large business. But we need to see that the founder genuinely does have the scale of that ambition and a plan. We know that the plan will ultimately not happen in the way that we think, but the fact that the founder's done the thinking and laid out the path to something really big, that's what excites us.
How do you think politics and geopolitics is affecting trends in investment? Is Brexit still an issue? Will the general election perhaps change anything? And in the wider international sphere, how is that affecting investment in we invest?
Well, we've seen quite a lot of changes. We cover Bangladesh, Philippines, Vietnam, and Indonesia and Asia. And we also cover the Middle East. I mean, we went from gaining a couple of new LPs to losing them all last year, just by the circumstances of what was going on. So yes, it also affects the fund managers, not only the startups. So that there's an element of geopolitical risk that needs to be accounted for. Now, it usually will create instability in markets that, or having a growth rate of, let's say, 6 to 8% year on year. Now, because of a perceived risk, doesn't need to be a risk that there's a potentiality of something happening, that insecurity will actually make you lose over 2%. So you're going to be at a growth rate of 5%. But that has huge implications in terms of how quickly your markets grow and which you're playing. So we've seen people recalibrate their budgets. That happens. Or that's the risk in emerging markets, as the currency risk. You had effectively $60 million in revenue, but the currency started losing against the dollar. Now, translated, your effective operational result is $44 million. That's your risk. So sorry, that's got. So it's unfair, but we don't make the markets. That's the reality in which you play. Then, as a founder, you can hedge your bets. Some are able to grow and kind of figure out the external risks, either manage their cash very well. So some guys will have a USD account where they keep all the dollars they've raised and will actually get money lent against that dollar at any time they actually need cash in the market. So they won't be exposed. So there are best practices around that where we can help founders. And then external risks, you cannot plan them all. But there is a higher number of them over there. Now, general election here might have consequences, and it's unknowns at this point.
So yeah, there's both a positive and a negative, and the negative one you probably spoke about a lot of it, right? Talent's a bit harder to find, inflation's made burn rates go up massively, but we're seeing a lot of companies that are looking to basically onshore critical infrastructure, and so like there is a lot of demand now for no longer relying on China or Russia or other countries for technologies, for infrastructure, for manufacturing. And so we're seeing loads of companies actually that are saying, look, we want to rewrite manufacturing. We don't want to rely on countries that we're not sure about the political relationship with. So we're going to build tech first, native manufacturing facility from the ground up in the UK or in Europe. And that's also quite exciting.
On that basis, most of the investment I'm seeing in that area in terms of building UK startups as unicorns is actually coming from outside the UK anyway.
The investment,
yeah. And it's trying to stimulate the city in London. We did a paper 2 weeks ago to do that, to actually start investing in our UK unicorns rather than others. But they've been ignoring it for 25 years, so why should they wake up now?
Yeah.
Is there a question in the middle?
I'm just interested in terms of pre-revenue and post-revenue, just in terms of how you work with founders or boards, and given the amount that you invest, how much influence you want on those boards and on those decisions?
So I think calling it boards and calling it influence is a little bit misleading. Right? It's like I think of some of the ones I'm on, it's like a 6-person company or a 20-person company, and the founder I'm on WhatsApp with and would have they can ring me any time of day. Yes, we have what might be called a formal board meeting in some cases, which is a quarterly catch up where they run through the reports, tell me what's wrong. But I think in terms of what influence do I want to have on the founder, I want the founder to build their business. I want to make sure they're aware of what we're good at. We're good at fundraising, right? So I want to make sure that they're aware of the milestones they need to reach to unlock the next amount of fundraising, and just be aware that they need to be building towards that. And so, look, I'm not here to tell a founder what to do. It's entirely their business. I just hope that I can lend the investor perspective as they grow.
It's a real basic back to the cap table that we were talking about before. So when it comes to pre-seed and Series A, how much percentage of equity do you want the founding team to have, and then how many
Other equity holders, do you think that's just too many for us to actually get involved in?
Good question.
Yeah. I've seen very different things, and I was comfortable with. I was more open-minded in the past. Now I invest in a company and justifiably so had over 30 investors at Series A. Due to the founder not being good at fundraising, so anybody with a check of $25,000 and more, please come on the cap table. Now, this is a bottleneck. He still had a decent amount of equity. I do prefer to see at least a team, and that's adding management or an ESOP and everything to be over 65%. Now, it's not always the case, depending on how long you needed to get there. We have seen teams that raised, well, it's a tough one. I understand you need to raise money, you give equity away, that's usually the deal. What we've done for certain companies where we found, okay, it might become a problem, we built in, as part of our shareholder agreement with them, equity kickers. So it's like warrants that convert if you hit the targets. Like, for example, if we go back to the other question of what's the value, what's the exit, probably I don't want you to have an exit right away. I want to keep you motivated. Maybe you have another 5 years at building this, but if you feel like you're left with 12% of what you've built, at some point your motivation will become shaky. I don't want that. I want you to be at your best. I'll say, well, if you hit all the milestones you put on the company that's validated by the board, well, you get something back. Like, it's yours. We will dilute a bit more as part of the next round, and that can be going for 25 basis points to up to 2 full percent at a Series C. But that's really depending on how good of a relationship you have with the founder. We've done that.
We like to say, I mean, we're at the pre-seed stage, so many businesses we see haven't raised funding already. So it's like entirely clean. It's just 2 founders, 3 founders, 1 founder. Sometimes they've raised some angel money, and like angel round, I would say giving away max 10% is roughly a benchmark for kind of the SEIS, EIS amounts in the UK. I think I disagree slightly. Like we're quite comfortable with businesses, actually, when we invest alongside us, we're actually really comfortable with lots of angels. These are going to be champions of your business, and as long as founders can go through, okay, this guy might have only written a 5k check, but he's really useful, he can connect us to these companies, and we've got businesses that have, one of my most recent investments probably has 60, 65 angels, and they're going after loads of types of businesses, and they send around to the investor group a big Excel spreadsheet and says, oh, which of my investors can connect me to these people? And the angels just go and connect them to them. So, like the quality or the types of people, like being able to explain why people are on your cap table is important, but we're comfortable with having lots of angel investors. And we are around, we are around pre-seed. We typically expect founders to give up around 20% dilution at a pre-seed.
And one quick add-on to that, just make sure that the legal terms are straightforward so that at the end, when you're at exit, you're not hurting cats and running around getting signatures that are blocking the thing from moving forward. So good legal counsel, again, is critical there.
Definitely.
So just to build on that, in terms of the founders, what sort of equity split in a very tech-heavy company between the kind of tech founders and the non-tech founders starts to be a red flag for you in terms of like equity imbalance?
We like to see founders equal, or as equal as possible. And even if founders have done some work to that point, so we often see, CEO has been working on this for 6 months, CTO joins, and so CEO has 80%, CTO has 20%. We really don't like that. If there's going to be a difference, it has to be small. And the reason for that is that the value that you build in equity, basically all of the work hasn't started yet. It's all going to happen over the next 10 years, and it's going to happen together. And so the work you've done today is tiny compared to the work that you need to do. And if you have these really inequitable splits of equity, it leads to problems down the line.
I'm with him on this. You don't want to have differences between founders because you're literally pouring trouble in a team. And we've seen situations where it's like, okay, personal reasons, you have to leave the team. It was not your choice. There are good leaver, bad leaver clauses, although sometimes they don't mean anything. That's another thing you should know as a founder. When you do a deal like this, they're not all enforceable, right? So if you want to go fight your battle, fight it. I know stories firsthand where founders have pushed other founders to leave to just get their equity back. That's nasty. You don't want, so by default, you want something that's as equal as possible. Sometimes the issue is, let's say you had a founder who's left the company and who was sitting on a sizable stake of equity. Well, you've been gone for 3 years. The company was doing $1 million revenue. Now it's 100. What do we do? Like the team is working day in, day out. Do you reallocate some of their shares? So it's also being able to have those tough conversations. What we try to do is that obviously founder shares have other rights than common shares. We try to help smoothen out any issues on that level, but sometimes you have conflict. And we just hope people stay sane.
So that's a really clear message you're sending us. You want equal shares. You don't want the 75% of.
For founders, not for founders. Yeah. Sure, if you've got early employees, whatever, but if you're a co-founder, we'd expect it to be very, very equal.
Otherwise, you're not with your co-founder.
Otherwise, you're not co-founder.
If someone were to be fortunate enough to have multiple term sheets, how would you advise them in choosing the right firm, right fund to go with? This is your chance for your commercial.
I mean, I would ask each fund for references. I think it's very, very normal, and they'll give you 2 or 3. I'd probably take one of those and expect it to be good. I'd then go on the fund's website and take 3 at random, probably with businesses that are similar to yours, maybe with some that aren't growing so well, and definitely ones with the lead investor from that fund. So go and do your diligence on the funds. Absolutely play them off each other. Don't tell each fund the name of the other fund because the community is really small. The moment you tell me the name of the other fund that's looking at it, I will go to them and I'll say, "Oh, you're looking at this company," and you lose all your leverage and buying power. So yeah, you need to stay secretive for as long as possible, and due diligence on the company.
Your poker skills you're using.
Yeah, exactly right. Exactly right.
I'm glad we're not in the same market. So we are dealing with smaller communities of investors. So usually when the deal and it ends up on my desk, I know it also ends up on everybody else's desk. You have not that many sources of capital, so it's either I call the other VC firm, because at that point we're not competing. We're competing in the same market, but let's say you want to lead that deal, I'm not that convinced, maybe you'll get me to convince and co-lead with you. So I think that situations where founders were able to make it a positive, align those who actually have an interest in a company to come together, because they know that they don't want to have one investor who holds all the cards afterwards. And they probably also bring value on different aspects of the business. Some can be like we've seen that have local investors because they want to have someone specific from an industry to help them. We come in as the hybrid who's kind of local, kind of international, and that's what they want because it's part of their trajectory. But as a general advice, I would go and see the investors that have been have dealt with you in the most kind and fairest way, usually, because it's an indication of how they will treat you overall. Be able to also ask them the tough questions. It's like, okay, you're going to invest now for the next 5 years. What do you expect? And the expectation management should go both ways. You have expectation and your ability to have very frank conversations without being emotional about it or putting too much ego. And in the beginning, it's tough when you're dealing with investors. It's a whole charming operation, and you want to really convince the person who was across that it's a great idea. And they might you want to get all the, let's say, the barriers down. Sometimes it's also good to be able to see, okay, who's challenged you in the right way? Who asked the right questions? Who can push you? So it's about balancing both. And if you like both, you can also go to them and say, listen, we like both, talk, come back. Usually they don't both walk away, that doesn't happen.
No, sometimes they compete. And if Sequoia likes a deal and Benchmark finds out, they will get on a jet, their own jet, Sunday morning, fly down and try to close it just to trump the other.
And losing a deal, right?
Losing a
when
deal.
you give a term sheet and you lose to someone else, that is like really bad as an investor. So the founders that are in a fortunate enough position to have multiple term sheets, you can really crank the screw because losing really, really hurts, and you carry it around for a while. So
and it's tricky. And hopefully the terms don't get so weird that no one makes money, because you need a healthy environment, right? VCs need to make money, founders need to make money, and the companies that acquire you need to make money. That's my personal philosophy. Spread it around.
One more question.
Hi, my name's Mark. I'm going to lean on the no arseholes rule a little bit here. Recently, we had a situation. I'm a tech business, a pre-revenue business right now. We were talking to a consortium in the States about a month ago, and they were promising within 12 months to deliver $3 million in revenue. And this sounded all quite good. It kind of made sense. Their strategy made a bit of sense, but within about sort of 2 or 3 rounds of communication, we had red flags going off everywhere. Like, these guys are kind of like shooting from the hip, they're changing what they're saying, something didn't work, and we actually turned around, I had one of my board members in the room here, and we had a bit of a call and we said, what do we do here? Because this is sounding like a really nice promise, but it's really flying in the face of our no dickhead rule. And we walked away. So, is that a good thing to do? The right thing to do? Is there any advice you should offer in that situation? Is walking the smart thing to do?
I mean, I would probably need more specifics to give you a proper opinion, but based on what you're telling me, I think commercially, there are many times where we've also seen some of our companies just deciding to stop wasting time. If people are not coming back with something solid, meaning an agreement we can sign with penalties and commitments from both ends, it has to cut both ways. Because if you're just dangle the carrot day in, day out, I've seen too many founders saying, oh, we have big customer coming up, and usually it's either they want your information. I've been victim of that as a founder myself, actually through an acquisition process. So especially with the US, get NDAs out, get legal paperwork done, because they will respect that. If you're being too nice, they won't respect you. So be able to also stand your ground.
I trust you go.
Exactly.
Just a question. So most of the innovation is happening in the tech sector right now. But what would be your advice for a company that's not in tech, right? It's in the more traditional sector.
What kind of traditional sector?
So making coffee, for example. How would that type of company show traction between investors before they have the product out?
I would consider like all types of funding that are available. VC funding is one of 10 like forms of funding for the business, and it gets a lot of media attention, and it's quite glitzy and it's quite glamsy, but it isn't fit for all businesses, right? And so, I would really sit down and think about, is VC the right business, right? There would be brands, and there are D2C brands that go down the VC route, but there's not many, and it's very, very hard. And as Playfair, we wouldn't look at a D2C brand or a coffee business, for example. It wouldn't fit our model. If you are going to go down the VC route, there are some really good resources. One's called Concept Ventures released it. It's called Fund Finder. And it basically lists all the funders in Europe, what they look at, what stage they invest at. It's basically, you can go on and you can put in, we're a pre-revenue company, we're business to consumer, and it will narrow down the amounts of funds that could be interested in that. And I recommend actually anybody before they fundraise, do that. Make sure you're not wasting your time on people that will never invest in your business.
Yeah, adding to that, if it's consumer-oriented, there are some cases where VC might make sense, because you're trying to catch a market that, you have a first-mover advantage, and it's all about brand, and you have some VCs who are very good at that. They just do that, and they would be the right people to talk to. But you should be also able to know what their expectations are, and if you're ready for that, because certain businesses are not made to scale. Or you're really fighting against a lot of business physics to really make it happen. because you're not going to get there in terms of either margin, because you're not able to grow, you're not going to get economies of scale, which you can do with cheaper sources of capital at that point. I have seen players backing coffee-based companies in the market where they change consumption trends. But to get to that, you need to play at a very high level. Like it doesn't happen. There's one case in the Philippines called Pickup Coffee. They're challenging they're beating Starbucks at their own game over there. So you have had, like, Starbucks was kind of a VC-backed coffee player like that, but it's more than just coffee. So you're offering something, like, you need to think about what you're doing, not just in terms of coffee.
Be disruptive.
Yeah.
Take over, change the market with your product. I think that's all the time we have for questions. Thank you very much. You guys have insight.
Yeah, thank you very much, and thank you for your attentiveness. So I just want to do like a quick experiment. How many of us are founders? Oh, thank you. Okay, so how many started a company within 3 months from now? Maybe you're going to launch a company in 3 months. Okay. All right. So I just want to call 2 people up for an elevator pitch. You pitch to the audience, you pitch to the community what you're building, and in 2 minutes. So if you're up to do that, let me see your hands up. Okay. I'll pick you, and I'll pick you. In this space, I'll pick you too. Come on, first. Let's go.
Oh, hi everyone, how's it going? My name's Adam. Basically, I'm the owner of Heaven Eco Hub. We, for 3 years, have been designing technology to support people through the 3 pillars of life, which is supporting people finding love, a life partner or soulmate, financial stability, and also personal wellness. We've built all of our investor portals. I'm also the owner of Heaven Token, which is a cryptocurrency, currently on the central exchanges. And we have an application called Heaven Soulmates, which harnesses everything that I've just kind of explained with the 3 pillars. And in 3 months' time, we're introducing a wearable technology, which is a AI smart ring, which connects to all of our technology. So basically, people attach themselves to come on a life journey with us. And we build technology to support people. So just wanted to say hi, and if you want to talk, I'm going to be here. Okay.
Hi, my name is Lavinia, and I'm the solo founder of Wellmatch, which is a marketplace platform connecting freelance and self-employed wellness providers to clients in a streamlined manner. Basically, what we've identified is 2 problems, one on the provider side and one on the client side. On the provider side, obviously, we're talking specifically in this case about freelancers and solo traders, so not salons. And there's this feeling of like really having a struggle in terms of building your business because not all of them are really business savvy. And there's also a huge problem in terms of like payment, scheduling, payment recovery, chasing your clients, homogeneous client base, and the lack of an ecosystem which promotes cross-referral. On the client side, instead, the huge problem is the lack of peer reviews, treatment effectiveness, and the fact that you have to rely on, time-consuming word of mouth and Google search to find like the right match for you. So the idea behind Wellmatch is to really like solve these problems in a streamlined manner, but also creating a sense of like community, whereby like gamification and cross-referral is promoted to create like a kind of like a multiplier effect in the solo trader economy. So,
thank you. So I'm going to take 2 more people. I'll take you, and I'll take you. Okay. Talk first.
Hey guys, so I am working on a platform called Lifetimes. So roughly 22% of people have no idea what their grandparents did. And I think it's 1/3, so like nearly 33% of Americans do not know where their family came from before. So we live in an era of the digital world. We're inundated with digital content. So what I'm building is Lifetimes, where you have your family tree, and then each person has their own profile. So similar to a LinkedIn or a Facebook, But here you specifically store the key moments, memories, or experiences that you want to share with the future generation, because we live in that digital era. So it cuts out the clutter that Facebook has, the latte you had 3 years ago, or being invited to that summer barbecue you never went to, all of that kind of stuff. But also what's going to be built in within it is, I do a podcast as well which touches on this stuff. So like the top 5 questions that you can ask your auntie or your grandma, or even your mother, to get that key experience or life lesson, anything that they want to share in their words, and to automatically upload it to the platform. So that's the basis level. There's more things that will come, but yeah, right now that's the plan, is to just build something where it's key moments, life experiences, because you don't want your great grandkids to have no idea who you are.
Hey guys, my name is Matt. I work in that super sexy subject called data protection or privacy compliance, if you've come across that. It's a very fun exercise. Like typically companies, what they have to do at the start of the journey is they have to work out what personal data we have, where it's stored, how it's used, etc., etc. It takes about a year. It's a pain in the butt. What we're looking to do is actually, instead of taking an integration approach, so the typical solutions now, they integrate in all the systems and then they pull out the metadata in these systems. We're actually looking at doing a screen capture approach. So we plug into the back of a device and we just watch what the employee is doing throughout the day and work out what data points they're using, where they're storing it and what activities they're using, and then pulling that into their compliance documents. And why that's a benefit is because without a clear visual of what data you're using and how you're using it, you can't comply. If you don't know what your employee's doing, you can't mitigate against potential human error-led breaches. And so from after that point where you get that standard view of what actually happens in a business, then we can actually flag activities like maybe there's too many Excel spreadsheets being shared through emails and it only takes one email address before there's a data breach. Or maybe there's someone that has access to a data point in a system that they shouldn't have access to because it's outside of their role. So that's what I'm building at the moment. I shouldn't say we, because it's only me at the moment. I'm looking for a co-founder, so if you're technical, please come and talk to me. But it's Comply AI.
Thank you very much. So for those that will stay back till the end of the event, so the next event, the main event I mentioned earlier, so this is the link, this is the code to get a free ticket. So you can take a picture or just VIP, just keep VIP in your head somewhere. So next time you get a newsletter and update, know that the link to the ticket is VIP. So hope to see some of your faces at our next event. Yeah, there's food and networking back there, there's food and networking back there, and that's the end of the event. Thank you very much.